at the slideshow here for this particular item. I'm just going to take it out of presenter view. Okay, and let's go ahead and put it in tablet mode. And this was the one that we were sort of, I guess, struggling with a little bit towards the end. Bill and Mercedes have $160,000 of taxable income, an additional $10,000 of non-taxable income. Classic example is municipal, state and local bonds are typically not, the interest on that is not taxable at the federal level, so they're just calling it out as $10,000 non-taxable. And then they told us to using the 2016 married filing jointly. And again, I forget exactly where I got this. I don't know why they put 2016, but when you look at the calculations more carefully, we see that they actually use the 2017 schedule. Okay, so I have the 2017 rate schedule sort of embedded here. And they tell us that if they receive an additional $80,000 of taxable income, what is there? And we're going to go ahead and do the tax due, the average tax, the effective tax, and the marginal tax rate. So if we look at the tax due, they are what? Married, and they are filing jointly, right? And their taxable income is this 160. Okay, we don't take into account this additional 10,000 of non-taxable. So we just simply look at the taxable income there, 160, and so that means that they're in this range, right? They're within that range on the married filing jointly tax table. And then they tell us that we have to take this amount, so we know that it is at least what? This $29,752.50. Okay, so they're just picking up that number plus 28% of the amount that is over, and we pick the lower range, right? Okay, so if you look at the difference between 160,000 and 153, you get, someone got a number for me? 160 minus 153, 100. Guys, you got to bring your calculators. You got to do this with me, or I'm not going to do them. Huh? 6,900. Thank you. Okay, so we've got 6,900 is the amount over times what? Times 0.28, the 28% of the amount over. Okay, and so that gives us what? 28% times 6,900. Guys, okay, let me make sure we got it straight. In this class, you got to bring the calculators and do it with me, right? Okay, there's not just, it's not watching, it's doing, right? What was it? 1,932? Okay, so 1,932 plus what? Plus this 29,752.50. Should yield us what they came up here with, which is this 31,684.50. Okay. Okay, so that's what we were trying to do the other day, and I just wanted to make sure we completed that because we had the wrong tax rate schedule up there and we just kind of started struggling with it. Okay, so now we want the average rate. Average rate is simply what? Simply whatever the taxes that you paid divided by whatever the taxable income is. So that one's pretty easy, the average, okay? Effective rate is simply going to sit there and take what the taxes that you're paying divided by your total income. So now they consider the what? Non-taxable to get the effective rate. And the effective rate, assuming there's non-taxable amounts, the effective rate is always going to be lower than the the average rate. Okay? And then when we talk about the marginal tax rate, it's how much tax are you paying on that next level of income that you're making. And in this problem, they're telling us that they had what? That they had an additional 80,000 of income. Okay, so what we would do for that one is go ahead and take the 31, take the tax at this point now, the additional tax they're paying. We have to first get this number of the 54,417, and so you take a look and you notice, and I'm going to erase these other numbers here, these other marks here, that we're still in this range, right? We're between, no, we've come up, haven't we? We're now between what? 233,000 and 350, 350 and 416. So we're going to pick up what? 52,000 to 22250. And now we're going to go ahead and figure out what the additional amount is, which is the amount that's over this, what, 233? Okay, thank you. But let me just go ahead and write it down so we can see where we're getting that number from. So you're saying the 240,000, which is the what, the 80 plus the 160 minus that lower end of the threshold, which is 233,350. Thank you. And you're telling us that number was what, 6,650? Okay. And so that's the additional amount that we're going to pay above this, what, 52. And so we go ahead and take that 52 plus the 6,650. We add those two numbers together. I'm assuming that's giving us, where are they getting this 54,417 from? Oh, thank you. Thank you. 6,650 times what? 33%? Thank you. Times 0.33. So they're picking up what? This number right here now is the amount for the amount over. Okay, so they pick up that 33%. 6,650 times 33 is 2,194 what? 0.5? Okay, good. Thank you. And so we take that 2,194.5 gives us, and that should give us the 54,417. Okay, is the 54,417. That is the tax that they're paying at that higher rate, and then we subtract off the 31,684, which is what they were paying when their income was lower, when it was just the 160. That difference divided by the 80,000 is going to go ahead and give us now this marginal tax rate of 28.42, and it's the what? The tax that we're paying now because we're at that higher level of income divided by the difference in the amount of income we're making. Okay. Question? Okay, good. So average tax rate, effective tax rate, marginal rate. Now, you know, there's software that you would use to prepare this, and you'll see they always give you those numbers because they just kind of calculate them. But now you understand a little bit better if a software is showing you that, where they're getting that. And the one that I hear talked about a lot is the effective tax rate. A lot of times they'll say, well, the U.S. has the highest tax rates in the country, and they're looking at what? The tax rate schedules, and just calling out to you and saying that they're taxing at these different percentages. Meanwhile, when you look, the average rate, the effective rate is often different than what you're seeing on the tax table. So when you hear those numbers, it's more talked about in economic discussions. You see that, that's where those are going. But you could be asked by a client or something to say, well, what's the marginal rate, what's my effective rate, et cetera. That's where those numbers are coming from. Question? Okay. All right, good. Let's go ahead and find my clicker here. And I think, did we talk about some of these other ones? Proposed taxes? I don't think we did, right? I think we stopped right there. So some of these other proposed taxes, and you know, every time someone's running for president, you know, one of the ones that are definitely not going to get elected, they're trying to like make themselves the candidates, you know, they're trying to make themselves stand out, and they'll say, well, I'm for a flat tax. Okay, flat tax basically says that we're going to tax on consumption, and we're going to tax at one rate, okay, whatever it is based on your consumption. So you pay, it's almost like a national sales tax, if you will. Some will talk about using a value-added tax. Okay, value-added is there's a tax paid on each stage of production, and ultimately the individuals that buy, the consumers, will have to, you know, pay the tax on that last stage. Now, this tax is said often to be what they call a regressive tax, and that it taxes more individuals at lower income levels because they're using a larger part of their income for consumer type items, right? If you're making $1 million a year and you go to the grocery store, you're not spending nearly as much of a percentage of your income on groceries as somebody that's making, you know, $100,000 a year, whatever. So that tax is often said to be regressive. Okay, there can be something similar to the national sales tax, which is similar to the flat tax, and then again we've talked about the value-added tax. And one of the problems with value-added, again, it tends to be a little on the regressive side. Okay. Okay, and this just shows a graphic as to how the value-added tax would work. And you notice that, you know, the person that originally cultivates the cotton has to pay a 10% tax for the cultivation, and when you sell it to the textile maker pays a 50-cent tax on the value that's been added. And since 10 has already been covered by the cultivator, they have to pay 40 cents of the total value added, and so on down the chain. And you know, we have finally that 80 cents of value-added tax. The total value-added tax is $2, and so much of it was paid at each stage of the process. That's a value-added tax. And again, you know, if you're someone that's spending a lot more of your income on these consumer goods, then that's really essentially comes out to be a regressive tax. Okay, just a couple things about, you know, the opportunities for tax. And you know, you could be in a public accounting firm and you could be doing tax, and you know, there's often, like I said, students will ask me, should I do tax or audit? And I always say, hey, tax if you like it. Okay, and so there's tax, there's oh, I'm glad I said this. I think it's on February 8th, and I'll have a more definitive date for you soon. We're going to have a panel of some tax folks, partners, and that sort of thing. That tax managers are going to come in and talk about their experience in tax. So it'll probably be mostly from the CPA firms, some of the big four firms, and some of the regional firms. And you know, we'll dedicate the whole class time to that, and there'll be like a little half-hour mixer afterwards, where you can just kind of come up and talk to them. So you don't have to suit up for it, but you might want to, you know, wear your please hire me clothes, but not the suit though. Okay, whatever. And so there'll be some folks that talk about that aspect of public accounting, most likely. I may try to sneak in someone from IRS or the state franchise tax board if I can dig through some of my contacts, or maybe even State Board of Equalization. State Board of Equalization basically does sales tax. So when companies have to pay their sales tax, an auditor will go in and make sure they pay the proper sales tax. And sometimes that's not a bad area of tax to get into if you're going to work for the government, because what? Today you're looking at 7-Eleven or something ridiculous, like, you know, something interesting like that. And then, you know, the next week you're looking at Apple and looking at their sales. And so you could get a cross-section of different companies and their tax implications of their sales anyway. And then, you know, you could be working for a firm in their tax accounting department, whatever it is, particular industry, banking, whatever. Okay? All right. components to tax practice, tax compliance, tax research, planning, etc. Okay. CPA exam, just so that we're sort of seeing how this fits into our overall objectives for passing the CPA exam, and it's sort of making about, when I say overall, an objective you may have for passing the exam. You could see that it's about 60% of the CPA exam, the remaining being business law and professional ethics. We're going to spend sort of most of our time in this federal tax of individuals and federal taxation of, I don't know why this is good to individuals. Could be corporate as well. So about 20% is individual, corporate. Little bit, not so much in federal tax procedure and accounting, and then a little bit on transactions. So we'll be covering about most of the 60%. There's some more specialized things that the exam gets into, and those will be sort of one-off as you go through if you study for the exam on that. Okay? All right. So with all that, let's go ahead, now that we finished up those chapter 1 slides, and let's see if we can work our way through a couple of the homework questions. Quiz questions, not homework, but quiz. We do have a TA. Okay, so Derek is going to be our TA, and he'll be here on Friday. And what he's going to do is, I'm working with him to have him select. Remember how I kind of gave you all the homework problems in Cengage Now? What I'm going to ask him to do is select and prepare certain homework questions to discuss with you, and he'll be announcing those out on Canvas as to which ones he's going to cover, and then you can come with him and work some of the specific ones, okay? So we'll be doing that too. But I got to get him into Cengage, and I wasn't even sure he was on board yet until Thursday. I found out that he was on board, so we'll get him in here on Friday, and we'll start that process, okay? So these are selected test bank questions, okay? Now what I do, guys, is I gave you these, but then I gave you like a ton of them also in the in Cengage Now. I basically released the test bank to you, okay, up to the number of questions they would let me. So pay close attention to these, because I'll look at these and then I'll look into the test bank and I'll see ones that are similar for your midterms and stuff. And so if you master the questions in the test, in the homework that are similar to these here that are in your quizzes, you should be in good shape for your exams. Okay, you may even work some of the very questions that will be on your test. You may work them before you actually end up taking the test. Okay. So let's take a look at some of these sort of theoretical. Which of Adam Smith's canons is not one of his canons, principles of taxation here? And good for us, the answer here is what? Simplicity. Okay, and the reason that's good for us, and that there's no real requirement that the tax compliance be simple, and it's not. Okay, so good thing he didn't have simplicity as one of his canons, or we might be sitting here, not having this good opportunity for a career in tax, right? Okay, you come over and you take a look at 2 here. Allowing domestic production activities, deduction for certain manufacturing income can be justified by what? Economic considerations. So if they're trying to help a particular industry, give a more favorable tax consideration, maybe giving credit for domestic production here. If you do produce domestically, we're going to give you a tax credit, right? And so that could help drive, jobs, in the U.S., whatever. They didn't do much of that in the tax reform, which was kind of interesting because they called it the Jobs Act, but then there wasn't a whole lot of giving of provisions to certain industries to encourage domestic production that would increase jobs. So they didn't do a whole lot of that. They went more with the trickle-down approach, which is if we cut corporate taxes, then they will what? They'll pay out more in salaries and that sort of thing is sort of the approach that they're taking. I don't know, you could have done something like this, and that might have driven the jobs aspect, right? Okay, but that would be a consideration there. I guess now, I heard today, although not as much related to what we're studying here because we're more income tax, but they're now going to put tariffs on certain imports for certain types of products like washing machines. They're going to charge a tariff now for those, okay? And again, you know, you could have given a tax credit for some sort of domestic production on these. What this tariff is going to do is it's going to increase the cost of the dishwasher, right? And so what's going to happen? So presumably you would, or washing machine, whatever it was, presumably now you'll buy a U.S. Washing machine because the foreign one is going to be more expensive because they're going to put a tariff on it. So that helps what? That helps local, local producers or producers that don't try to sell overseas. If you're trying to sell your goods overseas, what's going to happen? The other country's going to also raise a tariff up, aren't they? And so it's going to be probably harmful to exporters that are trying to do that. So I don't know, but that's the approach they're taking to try to keep jobs in the U.S. is through these tariffs they're talking about now. Okay, number 4, which of the following taxes represents the largest portion of the U.S. federal tax revenue? And it was what? Individual taxes. Okay, we saw that last time. Okay, number 5, Guillermo files his tax return as head of household. Oh, what I want to do before we do this one, it starts getting, well, we can do this one average, but then I want to go to one that's just asking does it tax directly, and then we'll look at some of these more complicated ones and start getting into the marginal tax and stuff. But average is pretty easy. So we have Guillermo files a tax return as head of household for 2017. Taxable income is $72,000. What is the average tax? Okay, so we have to go to the rate schedules here, and this is why I was hoping to have the where I could write on the board too, or at least have 2 things up at once. So let me find my rate schedule again. And what was that question asking 2017? Okay. So we look and they said he was what, 72,000? And what was he, single? Head of household. Okay, great. So he's head of household and he's at 72,000. So I go to the head of household schedule and I find what? He's in this range here, right? And he is at 72,000. Okay, so we know that he at least has to pick up this 695,250. Okay, and so you go back. Let's just make sure they pick that up. There's the 695,250. Okay, and then it's going to be what, 25% of the amount that's over 72,000. And just let's confirm that with the tax rate schedule. And so, yeah, sure enough, 25% of the amount that's over the that's over 50,800, not over 72,000. So we take the 72,000 minus the 50,800, the lower end of the threshold. That difference is then added, and we divide that by the 72,000. For the average tax rate, he gets the 17.02, right? Okay. And I might give you a couple of these on the exam. I'm not going to go hog wild with stuff like this because it's intellectually not that hard. It's just the mechanics get a little clunky, right, as you go along, and I'm not so much interested in can you slog through the mechanics because the software will probably calculate this for you, right? Okay. All right, good. Let's go ahead and take a look at this Manny, a single taxpayer earns, did I jump? No. Okay, we're right here, right? Number 6, Manny, a single taxpayer earns $65,000 per year in taxable income and an additional non-taxable amount of $12,000. And there's the city Boston bonds, whatever. Again, state and local interest is typically not taxable, right? And this question says, what is Manny's current marginal tax for 2017? And the question is trying to trick you into what? Thinking that that non-taxable amount is relevant to the marginal. They would have had to have done what? Given us a second additional amount of income that he made to have us start contemplating what? The marginal, okay? We could get into what is his, what is his tax? What is his average tax? There is no marginal rate if they don't give us an additional incremental amount of income he's making. So the answer here, what is E, none of the above? And some of those none of the above problems can be dangerous because you start hurrying and you're sitting there and trying to calculate, and all of a sudden you realize, well, why am I not getting any of the answers? Or you could, even worse, have one of the answers there that contemplates making the very mistake that you're trying to avoid here and end up missing the problem that way. Okay? Okay, good. By the way, if you're like, why do you keep telling us how to get the answers right on the exam? I can't help it. It's just in my DNA, teaching CPA review for all those years. So if I start giving you testing tips, forgive me. It's just part of my the way I think. Okay. So now we have what? Manny earning an additional what? An additional $35,000, right? And so now it asks us, what is the marginal? Can we calculate the marginal rate now? Okay, because he's got an additional $35,000. Now the mistake that I kept making with this stupid question when I was trying to work it is I couldn't figure out why when I took the $65,000 and I subtracted the $12,000 of additional income, why I couldn't get the answer. And the answer is I was not reading carefully, right? It's what? $65,000 is what he makes, and that other amount is not taxable, so it's not taxable. So you just don't use it in the calculation, right? And then I sat there and I did this a couple times and I thought I was losing my mind, and then I was like, well, no, I'm just dumb. Why did I keep subtracting that that 12,000? So it's what? He has a taxable amount of just, we pick up the 65,000, right? To see what his tax is at this amount. So we have 65,000, and we go over to the tax rate schedule. And what is he, single? So we go to the single up here, 65,000, and he's what, right about here? Manny is. So we know that he has at least what, 52265. Okay, so we can go ahead and put that 52265 down. So I would just go back to this one, and it's 2265? 5226, and then what, 25 cents? Yeah. Okay, great, thank you. Okay. And then we need to figure out the the extra percentage there for amounts over, and he makes 65,000, and the rate schedule will verify it is 37,950 is the lower end of the threshold for the single. Okay, so let me just verify that just so we're seeing where we're getting those numbers from. I know you know this, but you know it's accounting. Okay, so it's what, 37,950, and it's what, 25% of that? Okay, so we go ahead and we go back to the problem of the amount over 65,000 minus 37,950 is what, 27,050? Good, and we're going to take what, 25%? Okay, good. So that means we get what, 6,726.50, 762.50. Thank you. And we add them together, and that's now 11,988.75. Okay, so that's the tax before he makes what? before he makes this additional $35,000, right? But to get this answer right, we have to keep going and figure out, well, what happens when we consider this additional amount? So he's got $65,000 now, and he's going to make $35,000 more. So that means we're now at what? Contemplating income's at $100,000. Contemplating the income at $100,000. So again, we go back to the rate schedule, and now we start looking in the range at $100,000, right? And so when you start looking at the range of $100,000, he's now jumped up in here. Well, he's still what? At, oh, I got it head of household. He's up here now, isn't he? Okay, so when you hear people say, oh, I'm going to put me in another tax bracket, can't you give me a... That's what they're talking about, and then what, we're going to tax at higher percentages now, okay? So we go ahead and we know it is this $18,713. Right? Okay, so we go ahead and we pick that amount up, and I just want to write it on the problem that we're doing. So we've got 18,713.75. Okay, and now we got to figure out, well, how much on the additional amount, and it's 100,000. When I say additional amount, the amount over the lower end of that threshold. So it's 100,000, and the lower end of that threshold, I think, was 91.9. Okay, and so we've got an additional amount of 8,100 times what? Times the, and now it's 28%. Okay, so that's going to come out to 2,268. Okay, good. And then we're going to go ahead and have to add those two numbers together. And those two together give me 20,981.75. Okay, so that's his tax now what? At the higher level of income, right? Okay, now we have to figure out, well, what's the difference? And I guess now I'm going to have to write over here. This is why I wanted the board available, because this gets a little hard to fit it all in here. 20,981.75 minus the 11,988.75, what he was paying before he had this additional income. So we've got 11,988. That's also 75. Why are my auditor instincts telling me it shouldn't also be 75? But I guess this is a textbook question, so I guess it is. So they're both 75? Okay. And so that gives me a difference here of, I know it's going to be an even amount, 8,993. Did I do the calculation right? 8,993. I divide that then by what? The 35,000. What's the marginal rate on that additional amount of income he made, which is now sitting there at 35,000? 8,998 divided by 35,000. That was the additional income he made, right? And when I do that, I get something like 25.69, or give or take. Okay, so his marginal rate is what? Oh, I'm looking at the wrong problem. Down here, C. Okay. So you can, the main takeaway from this stuff is just, can you hang with the tedious process of going through, right? So you have to figure out the tax at one rate using the tax rate schedule. Then you do what? Take the difference between the what? The tax at the higher rate versus the tax at the lower amount of income. And then you divide that by the incremental amount of income that they're making, and that gives you the marginal rate. Okay? Okay, good. How about Leonardo and Teresa here? Leonardo and Teresa, and they ask us what? They ask us what is their taxable income? I mean, what is their what? Effective tax rate? Okay. Okay, good. So first we have to figure out their tax, don't we? Okay, and I'm not going to go through the tax rate schedule unless you're just dying to see another tax rate schedule thing. Okay, we just go ahead and we get the tax. Well, let's do it. We're still learning this stuff, right? So it's what? It's 80,000 is Leonardo's, and are we going to include the 15,000 to figure out the tax? We're not going to figure that out, and we're not going to include that. Good. So that's going to be what? 50,000 for Teresa. So that gives us 130,000 as the taxable income. Okay. And so we go over to the tax rate schedule. Let's just go ahead and do it, since they just gave us the number here. And we go to tax rate schedule, and we're married, right? I'm assuming they're married. They didn't say did they say they were married? I'm assuming they're married and that they're using the married filing jointly. So they're in here, aren't they? Yeah, but when I recalled this question, the question had them filing married. I understand, but we want to get the right answer, right? We want to get the right answer for this question that we're doing right now? Okay, right. That's what I'm saying. If we want to get the right answer, even though it wasn't very explicit, I'm telling you, the filing jointly. Okay. You know, they should have been more specific, you know, as to what it was, you know. But and then what they're going to say when they say, what if they file separate? We're going to have to do the separate and compare to what we already figured out. So that's going to work. So we are assuming they're filing jointly. Okay. So we go ahead and you look at the difference here, 75,000. They're in that range, right? And so we know they have to pick up what? 10, 4, 5, 2, 50. Okay, so we're going to pick that up. 10, 4, 5, 2, 50. There they're at. Make sure I write this down here. Yeah. Okay. 10, 4, 5, 2, 50. Is that what it was? Okay, good. Then we have to take the percentage of the amount that is what? Over the 75,000. So they're 130, and the lower end of the range is, just looking back, lower end of the range is 75.9. Okay, so we have to take the difference of 75.9. And the difference between 130, 75.9, I heard somebody clicking there, you get what, 54,100? Yeah. Okay, 54,100, and it's times what? 0.25, okay? And so that that product is going to be what? 13,525. Okay, and so we add those two amounts together, 13,525, 10,525. $4.50 and 50 cents, and we end up with 23,000. This number right here, right? Huh? 23,977.50. Okay, that's where they got that number. Okay, now that's their tax, and then if we were doing the average tax rate, we would just take what, the 130. But since this one asks for effective, you include in the denominator what? This non-taxable $15,000 of municipal bond interest. Okay. Okay, good. And then you're saying, what's your name, sir? Then you're saying for number 9, they're not talking to each other anymore, apparently, and they decide to do what? File separately. Is that what's happening this one? By filing married versus jointly instead of separate, right? I mean, why does this happen? This happens because they obviously aren't getting along anymore, right? Or they would, at least figure out a way to meet in a parking lot somewhere and, sign off on a joint return so they could save a few bucks, right? But for whatever reason, they just can't seem to, find each other, right? Okay, so they file separately. If they filed separately for 2017, so now we got to do what? Now we've got to first. We'll do Leonardo first. Okay, and so Leonardo is making what, 80,000, and so we go ahead and we look at the tax rate schedule, but now we got to go to married filing separate, right? Because we already know what it is for married filing jointly. Okay, so we're just going to go ahead and find it for the separate, and he's 80,000. So what? He's somewhere in here. So it's 14,876. Okay, so we'll go ahead and pick that up. That's 14,876 and what? 25 cents. Okay, and then we got to go ahead and figure out the increment. So it's 80,000 minus, and it was 76,550. Looking at the rate schedule, I'm just not going to click over there. That gives me a difference of 3,450, and the rate was the 3,450, and the rate was for amounts over was what, 28%? Right, he's right here. Okay, so we go ahead and we pick up that 28%. Times 0.28, 34,450 times 28% is 966. Okay, so we bring that 966 over, and so now he's going to have to pay 15,842 and 25 cents. Okay, good. So we got Leonardo. How about Teresa? So Teresa is at 50,000, right? So we take Teresa's 50,000. We go to the tax rate schedule. Again, we're on married filing separate. And we look at this range right here. Teresa turned out pretty good because she stayed up in that 25% tax bracket, right? Okay. And so what happens? We have to take 5,226.25. 5,226.25. So it's 5. Let me just write it over here. And this gets, like I said, I apologize for the messiness here, but it's going to be 5,226.25 plus, and what is it? 25% of the amount over what? Over. What's the lower end of this range? 37,000. Say it again. 950. Okay, so the difference there is 12,050. 050, and it's 25% of that. So 25% of that is going to be 3,012.50, right? 3,012.50 plus this 5,226. So her tax, this is getting messy, but her tax, 3,012.50, which was the 25%, plus the amount from the table, 5,226.50 is going to equal a total of 8,238.75, right? So 8,238.75 plus, what's Leonardo paying again? 15,842.25, and you add those two together, and the total tax there now is what, 24,081? 24,081 081, and they were paying, when they were getting along, they were paying what, 23,977.50. So this 24,081 minus 23,977.50 is giving us the answer here, which was B, 103,050. Right? Who paid that 103,050 more? Leonardo paid it, right? Okay, because what? In fact, we could have answered this question just by noticing that what? Teresa, whatever her name was, stayed down in the lower bracket where they were, and it was Leonardo that went up into the higher bracket on the married filing separate table, and so we could have just compared his income at the two levels if we wanted to, right? And that would have given us the difference. So what's the moral of this story? Huh? If you're married, find a way to get along to marry jointly, or if you're a real strategic thinker, marry someone who makes more money than you. And they'll be the ones who'll have to pay the extra. Okay? All right. Okay, I think that's enough, guys. Okay, I don't want to keep going on and on with these rate schedules. Okay, it starts to get a little bit horrible at some point. And I gave you a few more of those to practice with. I would not kill yourself with these. Again, I'll give you one, maybe two, asking you about the marginal rate of something. Again, software, God created software to calculate these kinds of things for us, okay? But, okay, good. Let's take a look at a couple more of these more straightforward ones, theoretical ones. Eliminating the current system of withholding income tax directly from employees' income paychecks would violate the convenience criterion of federal taxation. Okay, we have convenience, has to be fairly easy for the government to collect, right? Okay, we don't want them having to knock on every single person's door to get the money, right? The way they used to back in the biblical days. You hear, here comes a tax collector knocking, right? Very inconvenient, right? Okay, so we need to, have to have this withholding, okay? Which, if any of the following taxes are proportional? Remember, proportional tax is the same regardless of the level of the transaction, okay? Whereas a progressive, our income tax is classic example progressive. The more you make, as we've seen, the more you pay, okay? But sales tax is what? Is proportional, and that the more you pay for something, the more the tax, right? So if you buy a, Hyundai, you're not going to pay as much sales tax as if you buy a Porsche, right? Whatever. So it is proportional, even though the rate stays the same. Okay, number 13, value added tax. We said is regressive in effect, in that an individual has to pay a larger percentage of their income, right, for whatever goods and products they buy. And so it would be a regressive tax as opposed to the progressive tax that we have in our current tax system, right? And that's an argument against value-added tax, that it's regressive. Okay, I think that's it. Any questions? All righty, so let's go ahead and I'm going to go ahead and I'm going to save this. And what I'll do, guys, although I'm giving myself a lot of extra stuff to do, but that's all right. I will go ahead and post the marked up ones on Canvas as well, even though it's kind of chicken scratch, but you can always see what we wrote. And then don't forget, I'm recording this right now, so you'll also be able to see what I wrote as I went along if you want to have that printed out. So I'll put both the marked up version and the clean version. Okay, and I'll do the same thing with the slides. So you'll see two quizzes and two slides. One's marked, and I'll put marked up on the marked up ones in the file name. Okay. All right. So let's take a look at chapter 2. Okay. And did I tell you that the slides for the book are horrible? Did I make that statement? Okay, so they get really bad slides that came with the textbook. So even though you have access to them as part of your Cengage account, you can see the slides there. I will rarely use the slides that the textbook had because I was like, this is awful. Okay, but that was not the case in chapter 2. So for chapter 2, it's pretty much what they had up there is what I went ahead and used. Okay, and what we're going to just understand here is just, what some of the couple things, I guess. One, what is the legal hierarchy for tax law? What is the hierarchy for the courts when you have a tax dispute with the federal government? Okay, and then a little bit understanding of how to read the code, Internal Revenue Code citations, and then understand some of the additional administrative documents that IRS provides available to help you to research a tax issue. Okay, we won't be doing a lot of this in this class, but it's not a bad idea to have some idea as to the sources of the tax law that you'll be pretty much practicing more than researching here. Okay, so you have the Congress, right? Congress has the power of the purse. Okay, and by that we mean Congress is the part of the 3 branches of government: the executive branch, the legislative branch, and the judicial branch. Congress is the entity that has the ability to tax and the ability to spend money. For that reason, tax laws and spending laws, appropriation laws start in the Congress. Okay, start in the Congress. And did they shut down the government on you over the weekend? Okay, I'm sure you barely noticed, right? I have some friends that came over to watch the AFC NFC championship game, the football games this season, still work for the GAO, and you could see, they were going back for one extra, glass of wine before, the end of the thing, because they didn't have to work the next day. They knew they didn't, because they shut down the government. They don't, make you come to work because they're not going to pay you. Now they'll probably get back pay. That's the thing. Whenever they shut down the government, they always give the federal employees back pay for doing nothing. So it's like a paid vacation. Okay. So anyway, and the reason they shut down the government is because they couldn't pass the appropriation laws. There are 13 appropriation laws that they use to finance the government, and if they don't agree as to the law, they still have the money. They still took tax from your check, but they don't have the legal authority to spend it. Okay, so spending and revenue generation starts in the Congress, and the proper way to do it, I should say, is for a bill to start in the House of Representatives. Okay, now you're saying, well, wait a minute, I watched it yesterday, and the Senate voted first, and then the House voted. Well, they don't always follow this process. It doesn't really matter which cameral of Congress, the Senate or the House, actually goes ahead and starts the process, but it does start in the Congress, okay? But it's supposed to start in the House, and there's the House of Representatives and the Senate are made up of committees, okay? And it's usually about 13 members on the committee, usually whatever party is in power is the chair. So right now the chair of the Ways and Means Committee is going to be Republican. If the Democrats are in charge, it'd be a Democrat. But we have the chair of the House Ways and Means Committee. They initially vote for whatever the tax law is, and then they send it to the bigger part of the House, and that's when you get to pass legislation. You have to have a simple majority of 219. Is it 219 or 216? Nobody knows if it's 216. Okay, I think it's 216. It has to pass for a majority to pass in the House. Then they send it on to the Senate, and there's discussion in the Senate Finance Committee. They recommend to the larger Senate. The Senate votes, and depending on the nature of the law, it could be a simple majority, or it could be a 2/3 majority. That was the reason that they closed the government this time. For this particular item, they needed 2/3. Okay, but it just depends. Okay, so once they have gone ahead and voted in the Senate and voted in the House, there could be differences between what was agreed in the House and what was agreed to in the Senate. If that's the case, they have a conference committee and they sit there and work out the differences. And then once they work out the differences, they will go ahead and they will usually vote again, okay, on now what they call the reconcile bill. And then once it has been approved, it'll go over to the president. The president can either approve it or veto it. If the president vetoes it, they can still pass that tax legislation with a 2/3 majority override in both the House and the Senate to the president's veto. Okay? If you knew all that before you walked in here, but just a little refresher. Okay? And you probably maybe didn't know all these little details. And the reason I'm putting all that in there, I talked to the partner at PwC. Who did I talk to about PwC at the end of the last class? Okay. Whoever talked to me about texting me and you text me over the weekend, come and see me after. If you don't remember I mentioned PwC, that's okay. But come and see me after. I want to get you that information that we talked about. But I spoke to one of the partners at PwC on Friday at the luncheon that we went to, and he says that he's got quite a few things to tell us about the new tax law, the tax reform of 2017, and that they went so quickly through this process that he's saying that there are things that are in the code that if you look at what was intended in the law, there's a mismatch. And he has clients now asking, well, what is it? Is it what it says in the code? Or what we understood they were doing is they were going through this process. And he doesn't say, I have no idea what it is. So they kind of sped through the process a little bit. And you can see that if you're not careful to go through that process, and since it's a little bit, back and forth, you could make a lot of mistakes there. Okay? So anyway, we have had these different internal revenue codes that have come out over the years. The one we're studying is the 1986 code. The 2017 code will be in effect for what? For years starting 2018 and after. Okay, we're pretty much studying the 86 code. Okay, all right, good. Now we go ahead and this comes straight from your textbook. Okay, and we have that the Internal Revenue Code is found in Title 26 of the U.S. Code. So there's different titles in the U.S. Code that cover different topics. Title 26 covers tax. If you are in Title, I want to say it's 31, that's where banking laws are. Okay, so there's different sections of the code in which they talk about different subjects. For our purposes, we're looking at Title 26. Okay, and that's where the Internal Revenue Code is. Now we also have subtitles. Subtitle A is income taxes, okay? And inside of income taxes, there's other taxes. There's excise taxes, etc. For income taxes, we're in Subtitle A, and then we are going to be in Chapter 11, okay? And then Subchapter A, determination of tax liability, and we start with tax on individuals. and then they go ahead as our part, and then we see that we have these sections. When we go to tax on corporations, we're then in what? Part 2 of subchapter A. Okay, now you look at all this and you think, okay, this is how accountants, this is why accountants and lawyers don't have any friends, right? Because they have to sit there and go through code, so Title A section. Well, to help us out, what they do is they put the sections in consecutive order. So even if you go into a new part, a new chapter, whatever, a new subtitle, the sections, and I just want to go ahead and highlight the key takeaway here. Okay. Put my highlighter on. Okay. And we say that in referring to a provision of the code, the key is usually the section. In citing a section number, it is unnecessary to include all this information about the subtitle, chapter, subchapter, and part. We merely do what? We merely mention the section because the section numbers do what? Run consecutively and do not begin again. So just by calling out the section of the code, you are speaking specifically about whatever the topic is. And that's why you often hear section this, section that, and they don't bother to say, well, where are you? Are you under corporations or are you under individuals? We know by what? By the section. Okay? Okay, good. So when we talk about that, you'll see that. But then you hear some annoying people call out subchapters. Okay, and they'll say things like subchapter C, subchapter K. So subchapter C is for corporations, subchapter K is for partnerships, subchapter S is for, and I'm just going to go ahead and write in because you hear it all the time. I don't know if you hear it all the time, but you hang out at bars where accountants hang out. You hear all the time what? Subchapter S, or you hear S corps. Okay, so when you hear the term S corps, the reason they're calling that is that we're under what? And now we know that we're under subchapter S of the part 2 of the code, which is dealing with corporations that are small corporations, small number of shareholders. Small number of shareholders, we'll study later, from 10 shareholders or less. And if that's the case, instead of the corporation filing the tax return, they pass the income down to the shareholders, and the shareholders report the income from the corporation on their personal tax return. Okay, so they get what? They get the benefit of the limited liability of a corporation, but they have a different tax structure than if they were a regular C corp and they're taxed more as individuals than as a corporation. Okay. And there's certain other benefits to subchapter S. And in the new tax law, one of the sticking points when they were trying to pass it was that they provide tax advantages for S corporations. And I think the rule is now that they'll let them exclude up to $10,000 of income before they even get taxed on it. And that was one of the deals that they worked out for smaller corporations. And we'll get into that more later. Okay. The only takeaway right now is what? S corps is what? Talking about subchapter S of the code. C corp is what? Subchapter C of the code. Okay, but for the most part, what? Sections are what rules here. Okay? All right, good. Now you come over, and they give us some examples. And I think you can see that, okay? One advantage of having these big old screens up here as to the way you'll see citations. Now, when we look at citations, guys, it's really what you're seeing in the footnotes of the chapters. So as we go along, you'll see footnotes in the chapters where they'll be calling out the citations, okay? So you look at section is what? Is this little squiggly, okay? The section number comes next. The what? Then the subsection, the paragraph, and the subparagraph designation. You'll see that where there'll be citations that you'll see in the footnotes and stuff. And in this example, Section 2 is definition special rules relating to income tax on individuals. We're looking at definition of surviving spouse. And then in the paragraph, the purpose of the determination of the applicable rate schedule, it's going to be what? It's going to be, surviving spouse can use married filing. Remember we said last time married filing jointly for what? For 2 years. And to give you a little bit of time to find somebody else if your spouse dies, right? So for 2 years you can still file as married filing jointly. Okay? Okay, good. And you come over, and you're going to see they say throughout the text, and throughout the text, you'll see this symbol here, and when we say throughout the text in footnotes, throughout the text, and if they give you 2 of those squigglies, that means what? More than one section that they're referring to, okay? They may also sometimes call out these codes, and you're saying, man, 54 code, 39 code, I mean, there's still people filing amendments under 1939, and what's going on? Why would they even call that out? Well, what happens is if they don't make a revision to something that's in the new code, then they still call out the old code, okay, if something carries forward, okay? Okay, good. So just giving you a sense of how these are set up. Administrative sources of tax law. Now they call it administrative because these are publications pretty much of who? Of the IRS. So Congress sits up there and they pass a law, and then they turn to the IRS and they say, IRS, it's your job to what? To administer the laws, the agency and the government, right? Okay. If we were talking about a housing law, then we would look to HUD regulations, whatever, and the Department of Housing and Urban Development would write their regulations for their portion of the U.S. code. Okay, but for IRS, for tax, it's IRS's job. Okay, so they say Treasury Department, but it really turns out IRS is part of Treasury. What's the biggest department in the federal government? You can probably tell since I mentioned Treasury. And Treasury is the biggest department because the IRS is the biggest agency within the federal government, right? Okay, and so what happens? We have these documents that are administrative sources of tax law, such as regulations. Regulations are the top, okay? Regulations have the force of law because they give us specifics that may not be called out in the law itself, okay? And so the code will say so much, but then if we need more specifics, those are in regulations. And if they're final regulation, they have force of law. We can have revenue rulings, okay? Revenue rulings tend to be where corporations ask for a specific, or companies, often corporations, ask for a specific ruling from the IRS on a proposed transaction that they're probably thinking about doing, and they want to try to figure out the tax consequences. Those revenue rulings are specific to the entity, but IRS does publish those, and you can look and pretty much figure out, hey, if I enter into a similar transaction as covered by this revenue ruling, this is how I'm going to be taxed. Okay? Revenue procedures and various other administrative pronouncements tend to be more specific to a particular entity, and some of these may not even be published, and we'll talk about some more of these as we go along. Okay, so you can see some of these regulations, okay, as the force of law. And when we look at regulations, we can have a temporary reg and a proposed reg as well. If it's a final reg, it has the force of law. If it's a temporary reg, we may use it as precedent, but again, because it is temporary, it could end up being changed, right, as they go forward and get further refinements. Proposed regulation is a preview of the final regulation, and those typically do not have much authority other than that they're there to give us a preview of what's going on. Revenue rulings do not have the effect of law. It's more out there for you to see how things will potentially be treated. and you can pretty much use those if you want to determine what the outcome is going to be of a particular transaction that you're considering. These other things that they're talking about down here are basically sources, resources. Okay, they're not issued by the IRS or the government at all. So you have these different things: Commerce Reuters, Checkpoint, Commerce Clearinghouse, and I think our book comes with Checkpoint. Does it? You're going to have Checkpoint there that you can look at. And then they say Commerce Reuters, Checkpoint includes a wide variety of tax sources. The most significant of materials produced by the Research Institute of America, including the Federal Tax Coordinator, etc. So we'll take a look at that. Maybe that's something that I can ask Derek to take a look at. Maybe do a little looking at some issues there. But these are basically sources. I think most people use Commerce Clearinghouse. CPA is one that a lot of people use too. So, okay. And then we have letter rulings, and those are only applicable to the individual corporation whenever they ask about that. Okay? So U.S. regulation issued by Treasury, it's really IRS. They give us interpretations of the code. Okay? And when they come out, they can be what? Proposed. Okay? Proposed do not have the force of law. Temporary, and let's look at that, because temporary is a little bit interesting in that if we are looking at a temporary reg, okay, same authority as a final regulation. Temporary regulations must be issued as proposed regulations and automatically expire within 3 years after the date of issuance. Okay, so they are issued as proposed at the same time, and after 3 years, the proposed status expires, and a temporary regulation would become a final regulation. And then final, of course, has the force of law. So temporary and final are pretty authoritative, aren't they? Okay. And when they issued the temporary, they also issued it proposed at the same time. There's a 3-year shelf period there, and the temporary will become permanent if they don't make any changes at that point. Okay, so the main ones are final and temporary. Okay, and you can see the citation. Now, citation is kind of interesting in that they put a 1 in front of what? The code section that it pertains to. So if we're talking about the reg, if we want something for section 2, we look at that what? That second number. So if we're interested in something in tax code section 2, when we are looking at the reg, it's going to have a 1 in front of it, right? Okay, so when you see a citation with a 1 in front of it, like that, point 2, reg citation, that's talking about section 2 of the code. Okay. And then they show us here, and this doesn't get too earth-shattering, guys. If it's proposed, what do they put? Proposed in front of it. It's temporary, what do they put? Temporary in front of it. So that's pretty user-friendly. Okay. Okay, good. I'll tell you what, why don't we stop there? We'll say a few quick words about revenue rulings, okay? And then we'll go through, and I'm going to spend a little bit of time talking about the different court levels, okay, appeal levels, that sort of thing. We'll jump into the homework for Chapter 2. That when I say homework, I mean the practice midterm for Chapter 2, and then we'll probably start jumping in Chapter 3. And this is pretty much what we're going to be doing. I mean, we won't be always just looking at words. We'll probably be doing more of the calculation type stuff, but it's going to be what? Chapters and quizzes, chapter quizzes, okay? You may have noticed there was no attendance sheet. Do not fall into that false sense of security, because all of a sudden, bam, here it comes, right? And you don't want to miss a day where we're going over the quiz and you weren't here. All right, guys? Okay, have a good rest of the afternoon. I'll see you on Thursday. And don't forget, we will have discussion on Friday, okay?